Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Creamer. Today we are going to be analyzing PepsiCo stock, ticker PEP. Pepsi, this one came by request down in the comments section of one of my other videos. I last covered it last October. So over a year it's been, and I thought, it's a Monday. Pepsi's are pretty easy to analyze. Let's pick an easy one for Monday and fulfill this request. So that's what we're going to do today. If you have a request you'd like me to take a look at, just put it down in the comments. I'll get the ticker on the whiteboard behind me. Eventually I'll make a video if it's a stock that's in the S&P 500 like Pepsi is. Post those on YouTube for free. The rest I post over on Patreon at the $5 per month tier level. And I also have a $25 per month tier level on Patreon where I share a stock pick every week. And it will be whatever the best thing I can find in the market is that particular week. So I started that in October, the beginning of October. It's doing really well, and everybody likes it so far. So consider checking that out, especially if you're one of the people that thinks that I never buy anything. I own all the stocks that are going to be on the weekly stock picks, and if I don't own them, I will buy them before I share the idea. So let's see, where should we start here? As always, this is not individual investing advice. This is just how I analyze stocks. All right, so everybody probably knows Pepsi. They do Pepsi Cola and a bunch of other colas, but also a bunch of snacks, right? Doritos and stuff like that. Very steady earnings over the long term. If you bought this stock like 50 years ago, you've done really well. But it's now, I would say, a mature company, and we shouldn't expect like super big earnings growth in the future. So we can see that it's not, the stock price is not too the earnings are not too cyclical. That's this dark green kind of shaded area here, or the orange line. Let me see what the price did back here. Okay, so during the Great Recession, it only fell 40%. So it fell significantly less than the S&P 500 as a whole. So traditionally it's been, in the past recession, pretty stable relative to the market. I mean, a 40% decline, maybe it was more like 45 if I went top to bottom, like the tippy top. And then during 2020 COVID, down about 30%, not too crazy. That's pretty similar to the market. So we don't have a lot of earnings volatility, and we have less volatility in the stock price, or cyclicality, I should say. This is not like a daily measurement. I care about the cyclicality during big drawdowns. It hasn't been very cyclical. So neither the earnings nor the stock price. Now the stock price moves a lot more than the earnings. The earnings didn't fall 40%, but the stock price did. So that's something to keep in mind. Okay, so really what I want to know is how fast are these earnings growing over this kind of most recent time period from about 2016 to 2024. If we go on the fast graph, it will actually give us the point-to-point measurement from right here. Let's see, that's the beginning of 2016 to the beginning of 2025. Projecting forward, it looks like maybe one more quarter here to get to those next year's earnings. Right now, the market's expecting $8.15 per share this year, and we're almost there, so probably somewhat close, at least to that. I did notice this came down a couple pennies from the last time I updated this stock this summer, so things are getting slightly more pessimistic, I would say, but nothing too major. It's not like a big drop-off or anything. So from that point-to-point measurement, FastGraphs has an earnings growth rate of 6.64%. I include in my own personal measurement down years, so we had a minor down year here. And then I also back out the share buybacks that occurred during this time. So when I do that, I get closer to a 5% earnings growth. I would say that's right on the borderline of the minimum growth rate for a business right now that I would accept. We've had probably 3% inflation during this time per average for the whole time period. So you're getting a couple of points above inflation on a mature company, stable earnings, so on and so on. That all kind of makes sense. So it really just comes down to valuation. For me, I want this to be pretty cheap before I buy it, because I'm not going to be able to make that money just from the business growing, because they're not really growing that much. But they are growing, and they do have the ability to pass inflation on, which we saw during this period right here. So we had 3 years. They were able to grow earnings, 33%. Inflation was like 20% during that time. So they were able to grow earnings with inflation and maybe a little bit more, especially just a little bit more if you count 2020, which was just a flat year. So quality business, but not growing fast. That means we need to get a cheap price in order to get the type of returns that I want, which are for something like this. I mean, I want like an 8% long-term CAGR plus inflation. So in order to get that type of return, you need to buy when it's down. Like if you bought here, maybe you would get that. Let's see, 9%. Yeah, so you get 8% plus 4% inflation. So it does it right there. But you would have had to buy it right at the bottom of the COVID decline. So, and that will give you a pretty decent 5-year return, maybe even a little better if you manage to sell up here. And this would be one that I would probably sell if it got a little bit overvalued after I had bought it cheaply. It wouldn't necessarily be a long-term buy and hold because it's mature and it's not going to grow very fast. And if growth goes negative, the stock price will fall a lot. So there's a danger there, and you're starting to see that danger right now. So we had, we have these weight loss drugs that are coming out, and pretty much they affect all of Pepsi's businesses. So, and somebody mentioned that in the comments of my last video, which was October. I think it was before that big bump, like right before earnings, maybe like right in here. But, and I was like, well, if Pepsi hit my price, I would probably still buy it because I don't know how effective those drugs and things are going to be. And part of the reason you buy things cheap is because if it turns out you're wrong and next year earnings declines for no reason, then I can sell the stock and just say, well, I made a mistake. They're not going to grow earnings, assuming there wasn't a recession or some other explanation, or maybe revenues turn negative. So that type of a thing you can watch for. So let's get into the valuation here. So I'm assuming 5.01% growth. I'm using that earnings from this year, $8.13, which there's still 1 quarter to go in order to hit that. So that could be a little higher or lower, but that's what I'm using here. And then I pull the first year's growth forward. I do make an adjustment for debt, which is actually pretty small. So I'm treating this stock like it's actually trading at 180 instead of 158. So the way I do that, or where I come up with that, is I look at how much of a percentage more is the total enterprise value, which includes like debt and other obligations and stuff, compared to the market cap. So that's just the quick way that I do that. And you can see just glancing at it, it's not too much more. I didn't update this since the summer, but let's look at, I can tell you exactly how much I adjusted it, 14%. So I'm treating it like it's 14% more expensive because if you're buying the business, then you have to buy the debt too to get the whole thing. And that's what I run the valuation on. So when I do that, I get an earnings yield of 4.5% at the current price. So the earnings yield is the PE ratio, price over earnings, only is earnings over price. And then that will come out as a decimal instead of a whole number. And you just convert that to a percentage. So 4.5% earnings yield. Think of it like a dividend yield, only it's earnings, right? It's exactly the same, basically. Except for earnings are more important than dividends because dividends come out of earnings. Okay, so we have so if you bought the company for $100, you could earn $4.50 in earnings for each $100 that you buy. And that would grow at 5% a year. So I pull the first year forward, so $4.73 the first year. What I want to know is how much money I could collect after 10 years. So we go 10 years into the future, and our $100 would turn into $159.52. Put that in a CAGR calculator for 10 years. So you start with 100, you end with 159 over 10 years, and you get a 10-year business earnings CAGR of 4.78%. So that is, you can see it's colored red here. That means you could consider selling it because if you look at the 10-year treasury bond, I mean, it's at like 440 something right now. So it's probably not going to earn much more than that unless we have inflation, and then they can pass that inflation on. Like unless we have higher inflation than we've had the past 9 years, which is what I used for this. they can pass that inflation on. So this is more inflation protected, obviously, than a 10-year Treasury. But the actual return you're probably getting is, at this valuation, isn't very high over 10 years, using just the assumptions that I'm using. Let's see, how do I want to go about this here? So sometimes I would consider selling a stock if this was the number that was there. With Pepsi, it's hard to say because it's not going to fall as much during a recession, probably. But okay, so the other thing I wanted to mention that I just remembered. So the weight loss drugs are potentially a negative earnings produce. Like if enough people take them and then they don't buy as much Pepsi stuff, then they could earn less money and earnings would go from positive 5% to maybe negative 2% or something like that. And then the market would freak out and send the stock lower, like a lot lower. So this has a danger of actually losing your principal and money, like the money that you invest, or a bond doesn't. So I wanted to just make that point. So this isn't risk-free. The bond isn't risk-free too. The risk there is inflation. This is pretty much guarded against inflation, but it's not guarded against business disruption and competition and changes in consumer habits and all those other things. So you have to kind of weigh those things. They're different risks, but they're there for both products. So if you have a strong opinion on inflation or you have a strong opinion on the success of the weight loss drugs, then you could prefer one or the other, right? But this isn't, like, I want this to be 8% before I buy, which means the price has to come down. When the price goes down, my share of earnings that I buy goes up for every $100 that I spend on buying the company. So the price would have to get down to $81.30 for this to get to 8%, which is what I want. And that's 48% lower than where the stock is right now. Strangely, because Pepsi didn't fall as far as many of the other stocks in the market during the 2008 recession, it would actually only need to fall 30% during a recession to hit that buy price. So that's a little weird. Usually my recession buy prices are almost always lower than just the straight up math oriented ones. And so this is a little bit different than that, but the reason for that is it only fell 40% during the Great Recession, and it never got super cheap. So we've also had this multiple expansion that's happened during this time, which honestly should mostly be gone by now because we don't have 0% interest rates anymore, but the market thinks differently. So it only bottomed at a PE, like a 12 PE. That's not super cheap. There's stocks that bottomed at 2 PEs during the Great Recession. So it never got super cheap back then. So it might not get super cheap during a new recession because people might flock to it for safety. There are money managers who have to be in the market. And, if they're long only, then they'll go buy stocks like Pepsi that they feel are less volatile or safer, whatever. And that's what could prop this stock price up. So it's at a 19 PE now. If it only falls to a 12, well, that's about 30%, right? I mean, something like that. So that's where that kind of all works out from. So I wouldn't sit this is actually one where I'm I wouldn't, just because of the way the market behaves. I mean, it's not rational in my opinion. But there are structures in place that cause this with some stocks, like utilities and things like that, where I'm probably never going to see this $81 unless earnings really falter. And then that could come into play. But this will actually go lower in that situation. So it'll probably never be hit. This normal price will never be hit. But the recession one might be under certain situations. So it's kind of a weird one because it's kind of traditionally it has been a safe consumer staple type of business. I don't consider it safe because of the business disruption. Now, if they were growing 10% and I was risking them dropping to 5% earnings growth, that would be a much more attractive than 5% turning to minus 1%, because the stock will get absolutely obliterated, probably. we've seen it happen in the past with other stocks. So, okay, I think that's all I have to say about Pepsi. If you found this useful, hit the subscribe button, hit the like button. If you have a request, let me know what it is. I'll get the ticker on the whiteboard behind me. Once I write it down on there, I'll let you know in the comments that it's on there. If I don't reply to your comment when you're asking for a request, it's because I haven't written it down on the board. I try to write them down on the board before I tell people so I don't totally forget them. So there's a method to my madness. Sometimes I answer everyone's comments except for the 2 people that asked me for a ticker because I'm not in my office near my whiteboard or whatever. Okay, I'll see everybody later.